As the U.S. markets are currently closed, SoFi Technologies, ticker SOFI, finished yesterday's trading session on Monday, November 17, 2025, at a closing price of $27.03 per share. This represented a down day, with the stock falling 2.84% or 79 cents on a heavy trading volume of over 68 million shares. The session was volatile, trading in a range from a low of $26.55 up to a high of $27.95, ultimately settling near the lower end of that daily range, reflecting some profit-taking or broader market weakness after a significant run. Now, the immediate takeaway from that single day of trading is one of weakness. But the critical insight, the piece of information that separates a casual glance from a deep understanding, is what was happening outside of that 2.84% drop. Just hours ago, analyst reports began circulating, highlighting SoFi's massively upgraded outlook for the full year of 2025. We are not talking about a small tweak. Management raised guidance to project $1.035 billion in Adjusted EBITDA and $455 million in adjusted net income. This follows the blockbuster news from just last week on November 11th that SoFi is launching SoFi Crypto, becoming the first and only nationally chartered bank in the United States to allow its members to buy, sell, and hold cryptocurrency directly within its ecosystem. This one-two punch of a fundamental guidance raise and a major headline-grabbing product expansion makes yesterday's 2.8% dip look less like a warning sign and more like a momentary pause in a much larger narrative. The common belief, the prevailing expectation is that SoFi is still that student loan company. Many investors who remember its SPAC debut still lump it in with high-growth, cash-burning fintechs. They see the name and think student loan refi, and perhaps more recently, they might associate it with the SoFi Invest platform, seeing it as just another online investment app trying to compete in the crowded world of investing sites. They might compare the SoFi investing experience to the Robinhood app, noting that both offer SoFi fractional shares or Robinhood fractional shares of expensive stocks like Tesla stock or Nvidia stock, and assume they are cut from the same cloth. The expectation is that this is a company defined by student debt and speculative stock trading. The reality, however, is profoundly different. The company that just reported its third quarter 2025 earnings is not a simple lending app. It is a diversified, scaled, and, most importantly, a profit-generating national bank. SoFi has now posted 8 consecutive GAAP profitability, a milestone that most of its fintech peers can only dream of. The Q3 report from late October blew past expectations, delivering $139 million in net income. This isn't a fluke, it's the result of a deliberate multi-year strategy. The most telling number from that report was this: the financial services and technology platform segments combined now account for 56% of the company's total revenue. Let me repeat that. The business outside of its legacy lending arm is now the majority of the business, and it's growing at a staggering 57% year over year. The student loan company narrative is officially dead. The reality is that SoFi has successfully built a 3-pillar financial services giant. Let's break down those pillars. First, you still have lending, and make no mistake, it is performing exceptionally well. With the student loan moratorium firmly in the past, originations are robust. But it's the personal loan and home loan originations that are also firing, leading to a record $9.9 billion in total originations in the last quarter. The bank charter, which SoFi secured in 2022, is the secret weapon here. Unlike competitors who must rely on high-cost warehouse lines or other forms of financing, SoFi can use its burgeoning low-cost deposit base from its own checking and savings account members to fund these loans. This dramatically expands its net interest margin, or NIM, and gives it a durable structural advantage that the market is only beginning to fully appreciate. The second pillar is the technology platform, which everyone knows as Galileo. This is the B2B picks and shovels side of the business. Galileo provides the API-driven infrastructure for other companies, fintechs, banks, and even non-financial brands to build their own financial products. It's the engine behind countless debit card, payment, and digital banking experiences. The recent news that Galileo has joined the AWS Partner Network is a huge win for distribution. It puts Galileo services in front of a global audience of developers, a move that could significantly accelerate its growth. This isn't a consumer-facing brand, but it's a high-margin, sticky B2B revenue stream that provides critical diversification and scales beautifully. And that brings us to the third and most visible pillar, financial services. This is the consumer-facing one-stop shop that management has been building for years. This segment, which grew revenue by 76% in the last quarter, is the member acquisition flywheel. It includes SoFi Money, checking and savings, SoFi Credit Card, and of course, SoFi Invest. This is where SoFi competes directly with the legacy giants and the NewGuard apps. When you look at SoFi Invest, you're seeing a platform that aims to be everything to everyone. It offers SoFi Active Investing for those who want to manage their own individual brokerage account and trade SoFi stocks and SoFi ETFs. This puts it in direct competition with Fidelity, which offers its own robust Fidelity mobile app and Fidelity trading platform, and Interactive Brokers, which is known for its professional-grade Interactive Brokers trading tools. For those who want investment help, SoFi offers a SoFi Robo-Advisor, placing it head-to-head with automated services like Schwab Intelligent Portfolios or the managed Fidelity Wealth Management options. And now, with the launch of SoFi Crypto, it's making a direct play for users who might otherwise use the Robinhood app for Robinhood Crypto or Robinhood stock trading. This entire ecosystem is designed to work as a financial services productivity loop. A new member might be attracted by the high-yield savings account. Once inside the app, SoFi can market its other products to them at near zero customer acquisition cost. That member might then open a SoFi Invest account for their online investing or refinance a loan. This cross-selling is powerful. In Q3, 40% of all new products were opened by existing members. This is the flywheel in action. It's how SoFi added a record 950,000 new members last quarter, bringing its total to 12.6 million. Compare this to the platform wars. While Fidelity boasts its massive scale, deep Fidelity mutual funds lineup, and trusted Fidelity IRAs, and Robinhood leans into its simplified game-like user experience for self-investing, SoFi is trying to build a single, integrated ecosystem, where the whole is greater than the sum of its parts, and all of it is built on the foundation of a real national bank. Now, we must address the tension. We have this reality of incredible execution, record profitability, and massive growth. But we also have the reality of the stock's valuation. After a 104% run-up in the past year, SoFi is not cheap. Some valuation models, looking at its current 52.4x price-to-earnings ratio, will call the stock wildly overvalued, especially when compared to legacy bank industry averages. This is the core conflict for any potential investor. The expectation of the bulls is that SoFi will grow into this multiple, that its superior growth rate driven by its tech platform and banking charter justifies a premium valuation more akin to a tech company like Apple stock than a traditional bank. The fear of the bears is that the market has gotten ahead of itself, that the stock is priced for perfection, and that any macroeconomic hiccup, a slowdown in consumer credit, a regulatory change, or a stumble in execution could cause a severe correction. So what is the future outlook? The catalysts are clear. The full-year impact of the SoFi Crypto launch could be a significant driver of new members. The Galileo AWS partnership could open up new B2B revenue. And the continued mastery of the cross-selling flywheel, converting more of its 12.6 million members into multi-product customers, will drive profitability higher. The recent upgraded guidance to $455 million in net income for 2025 is a testament to management's confidence. The risks are just as clear. Valuation is chief among them. Furthermore, as SoFi's lending book grows, it becomes more exposed to credit quality. While its borrowers have high FICO scores, a broad economic downturn would still impact its loan performance. And it faces blistering competition, not just from apps like Robinhood, but from the 800-pound gorillas like Fidelity Investments, which has the scale, trust, and fidelity brokerage offerings to compete on every front. This brings us to the central question. Do you believe the expectation that this is a fintech stock that has run too far too fast, or do you accept the reality that this is a new kind of financial institution, a tech-powered bank that is demonstrating scalable profitability and has a clear long-term